Welcome. My name is Jeff Driver, General Manager of Business Development and Investor Relations for Mirrabooka Investments. I have with me today Mark Freeman, the CEO, and Kieran, who's the Portfolio Manager for Mirrabooka Investments. So Mark, we just announced our half-year results for the financial year. Perhaps you could just take us through what the key aspects of that result were from a financial perspective.
Thanks, Jeff. I'll just touch on the highlights and then we'll pass over to Kieran to talk about the portfolio and markets.
Okay, thank you.
Profit for the half year was $4.6 million. This is in line with the $4.6 million reported for the previous corresponding period. The interim dividend has been increased to 4.5 cents per share, fully franked, up from the interim dividend last year of 4 cents per share. The management expense ratio remains low for this type of product at 0.56% with no additional costs. The portfolio size increased to $668 million given the strong performance of the portfolio over the year.
So Kieran, Mark touched on the strong portfolio performance. Perhaps you could take us through the factors that has been driving the strong performance, really not over just the short term, but over the long term for us.
Yeah, sure, Jeff. Yeah, so for the 12-month period to the 31st of December, to do a portfolio return of 18.2% was obviously very pleasing and well ahead of the index, our benchmark at around 11% for that period. We've had a number of really good contributors to that result, stocks that are sort of well up in our top 20 that consistently performed. But in this period, particularly companies like Pinnacle Investment Management, Temple & Webster, Gentrack, which has been a star in our portfolio for recent years, Netwealth similarly, and interestingly a new company that we bought only a few years ago, Redox, has really started to deliver very well through this period. On the flip side of that, we really haven't had any really significant detractors in the portfolio, which we think is really important and sort of plays to that focus of ours of focusing on quality companies. We don't want to have those drags, and thankfully for this period we haven't had too many of those. I
suppose the other thing too is not really strongly positioned in the resources sector either, which has clearly had a very strong underperformance for the period.
Yeah, that's right, Jeff. And look, in saying that, it is important to recognise when you're having some tailwinds in the market, and we do think our style of investing, as you touched on, we don't own a lot of those cyclical resource type companies. We're looking to buy businesses for the long term, and we're conscious that the businesses that deliver the best results in the long term are those that deliver the strongest earnings growth. So that's how we invest, and in this environment we've been in, that's been a positive place to be. There's no doubt there's been valuation support for those sorts of companies, which has helped our portfolio performance, but we need to be aware of that in terms of where we are in the cycle now.
And I suppose in the context of Pinnacle Investments and Temple & Webster, you had to be patient there for a while because their share price was under pressure for quite a lot a few months ago or 12 months ago.
No, absolutely. And look, that's a feature of the way we invest. You think back to the last 5 years, there's been a lot of volatility through that period, some really buoyant times, but some really tough times as well. And importantly for us, we just focus on the fundamentals in our business. We're in the fortunate position where we get really good access to management to talk about those fundamentals. And we've learned to really block out the noise and just look at the companies and take our own view on where they're going over the next 3 to 5 years, which has paid off for us.
So in terms of changes to the portfolio, any significant changes you've made over the last 6 to 12 months? Or?
Yeah, look, so it's been a bit quieter. I guess in terms of that environment that I just touched on that's added to our performance, that's also made it a bit more challenging to really buy with conviction through this period. Because the sorts of companies, as I mentioned, that we like, have had really good valuation support, which means that really strong fundamental value has not really been there for this period of time. We've still found things to buy, but our buying activity has been a bit quieter than usual. The selling's been typical, around 20 to 25% of turnover per annum is what we do. So for this 6-month period, it was similar to that. But thankfully, we haven't really been selling things that aren't working, more just reducing positions that are really fully valued now. Which again goes into that realised gain surplus that supports our dividends, which is quite positive as well.
Any new companies you added of note? Or?
Yeah, we did. So we always like to tell shareholders what we've been buying. In this round, we've sort of been keen to mention that the positions are quite modest, and they're not companies we think are going to be spectacular in growth and going to become really large parts of the portfolio, but really solid businesses, things like Napier Port, which is a regional port in New Zealand, Channel Infrastructure, the key import terminal for fuels into the New Zealand market. Servcorp, which has been an owner-driver business we've followed for a long time in the serviced office market. And actually an IPO recently, Cuscal, which they do payments infrastructure for banks and financial players, which we think is a really solid market position as well. So good businesses, undemanding valuations, well run, sound balance sheets, but not likely to shoot the lights out for growth is where we've been buying recently.
Okay, thanks, Kieran. So Mark or Kieran, both of you, in terms of the outlook for the next 6 to 12 months, so what are you seeing there, Mark?
Yeah, well, look, we're sort of probably more broadly cautious on markets in general. It's really around valuations rather than the businesses themselves. I mean, we're biased towards quality companies, so we're generally happy with our companies, but we just think some of the valuations are high, and across other sectors as well. What makes Mirrabooka attractive is that we do have that mix between mid and small caps, so we've got some nice, really strong mid-cap stocks, but then when you look into the small stocks, there's lots of companies to look at, and what the team have done really well is be able to find opportunities consistently across the market and to keep investing in those opportunities to keep up what has been fantastic long-term performance.
Yeah. Kieran, have you got any further comments? Or?
Yeah, look, I think whenever I think to the outlook, you think about the things that are hard to predict. And there's one constant in that, which is where's market's going to go in the next 6 to 12 months. There's lots of people who tell you they know that. We have no idea is the reality, and everyone else has no idea, to be honest. The other wild card at the moment, what's going to come out of US government policy with Donald Trump in position. Again, we try and stay in our lane and just stick to things that we think we can fundamentally have a good understanding of. We don't think government policy out of the US is certainly not that. Longer term, I think the thing that we are really mindful of is, while high valuations don't really tell you much about 6 to 12 month returns because share markets can do anything, they are a really key factor in long-term returns. So that does make us quite cautious. It doesn't mean we're going to be heroic and pile into cash and pick markets, far from it. We'll stay invested in good companies, but it means we just need to be cautious about where we're allocating capital to make sure we're being patient for when there's really good value that will return. And markets are volatile, so we're confident that will happen at a point in time.
Okay. All right, Mark and Kieran, thanks for your time.
Thanks, Jeff.